Boy, it has been a busy day. Just to clarify, we don't always on a Fed interest rate decision day get inflation numbers a few hours before. I mean, it has happened on multiple occasions over the years, but it is rare. But it has certainly perked up the attention of the markets ahead of a rate decision by the U.S. Federal Reserve, where just about everybody is expecting the Fed to hang tight. If anything, we were just looking for some clues on what the Fed might do later this year, because a resilient U.S. economy and sticky inflation are a couple of the reasons why, over the course of 2024, expectations for rate cuts in the United States have come down. But, of course, our own Bank of Canada recently pulled the trigger on a rate cut. We're starting to see some momentum towards policy pivots around the world. And today, after cooler than expected inflation in the United States, all of a sudden you started to see people talking about the possibility of a rate cut in the United States in September again. For more on what the numbers are telling Tom Porcelli, let's get his take. He is the chief U.S. economist at PGIM Fixed Income. Tom, it is great to see you. Thanks for the time as always.
Yeah, good to be with you. And by the way, I love how you set it up. Like, I don't think you could have summarized it more perfectly today.
I've had many surface level conversations on inflation and interest rates for the last year, and that's the truth. The market doesn't like to go too far into the data, but they do just want to know, are we going this way or that way? And it has been a bit of a metronome for the market. So where are we right now?
Yeah, look, I think from an inflation perspective, look, there's countless ways of slicing up inflation. And while I'm very comfortable saying today's number was a great outcome, full stop, I think we have to recognize why. And it was because of auto insurance, right? Auto insurance has literally been a thorn in the side of inflation over the last year or two. In fact, it's been adding very meaningfully to inflation, about 0.5 month on month. Now, that might sound really small to most people, but just keep in mind, we're talking about something that rises 2 or 3/10 month on month. So it's been pretty notable. What happened today was that auto insurance fell for the first time, I think, since late 21. And what happened, and I think this is a really interesting thing, if you look at all of the other sort of big, sort of components of inflation, none of them really did anything very different relative to what we've seen over the last few months. But the simple act of auto insurance falling really allowed a lot of, sort of what was beneath the surface from an inflation perspective to show through. And what's beneath the surface is actually a pretty solid inflation story. I mean, inflation is, I think, much softer than most people seem to appreciate. But again, there's been a couple of idiosyncratic factors in particular that have really been doing a lot of the damage. I do have one other thing to say on that, the super core idea, which Powell loves to talk about, but I'll reserve that unless you want to go in a different direction.
Well, I think at the end,
yeah, go ahead.
No, that is helpful. And I'm glad you mentioned that component consideration for inflation. And, when we're covering the data here in Canada, everyone's always take it with a grain of salt. Monthly numbers have a lot of variables. But I think people are trying to figure out what kind of economy lies ahead. It is it's a unique time, too, because I highlighted how the U.S. stock market's at an all-time high. The Canadian market's not too far behind. I would say you can find plenty of people, though, in both countries that feel pretty stretched right now. So trying to get a real state of the economy really depends on where you're sitting. And I think a lot of people want to know where we're going to be sitting come the end of this year.
Yeah, look, I think by the end of the year, I think things still look pretty decent in the United States. I think decent but slower. I think that's a really important idea. It's something we've been talking about for quite some time. So if I think about sort of, how much slower can it actually be, just keep in mind a couple of things. And I think this really sort of neatly captures the sort of the inflation dynamic and the sort of the spending dynamic. When I look at inflation at large, there's, as I said at the top, there's countless ways of sort of slicing this thing up. I'll give you a really interesting way. Look at core discretionary inflation and look at core staples inflation. And as the names would imply, discretionary are sort of, the things that, you can sort of, go out and buy, that you want, right? Like a car, as an example. Staples are the things that you need, like auto insurance. If I look at that breakdown, I think this is, to me, this is, I think, really where the rubber meets the road, not just from an inflation, but from a spending perspective. It is the core discretionary components that are actually outright deflating. Think about that, right? Like if the consumer was out there just spending haphazardly, you would actually think that core discretionary inflation would actually be sort of really the thing that's doing a lot of the damage. It's not. It's deflating. It's core staples. And keep in mind, core, so not food. It's core staples that's doing a lot of the damage. Why do I belabor this point? Because what it means is that there's a lot less left for the consumer to spend on those discretionary items. Staples are chewing up a pretty decent amount of all of the disposable income that we have out there. Again, a relatively decent amount. And I think that leaves a lot less for the discretionary stuff. And so for me, I think it's a really easy argument to make the case that things are slowing down. And, this argument, so at a high level, I think people love to say, yeah, well, rates are really high. It hasn't really clamped down on the backdrop. I completely disagree with that. It's not that it hasn't yet. And you could see things like delinquency rates rising, which was initially limited to lower FICO scores. That's now bleeding up to near prime FICO scores. And I would argue that that's one of the key things that we're seeing that are really suggesting to us that things are slowing down in the United States. I mean, there's countless others, but just at a high level.
Yeah, and you're highlighting that this is not something that we can tie with a quick, small bow and be done with, but that's the way the market works. And then the market will undoubtedly key on one thing or another that Jay Powell might say today. What would be, we're almost out of time, but what would be the one thing you'd be curious to hear from the Fed chair, assuming rates stay where they are, but the market anticipation has been growing for rate cuts?
I don't think Powell has to really change his tune all that much. I think this idea of leaning more toward the dovish side, I think is exactly what he, is what the sort of the recent data will actually allow him to do.